Hello and welcome back, options traders. Last week I talked a little bit about morphing and the importance of at least considering potential morphs when you're setting up your trades. So I thought what might be interesting going forward is to every once in a while talk about some of the more powerful morphs that professional traders use. And so today I want to talk a little bit about one for a butterfly for those of you who may be using this powerful strategy. So a butterfly strategy, what is it? Well, overall, it is a neutral spread. And neutral just means we're looking for that stock price to sit still. We're not expecting it to make a big move up or down. We want it to stay relatively quiet. It is among a family of what are called hedged premium collection strategies. Premium collection just means that we are after the extrinsic value or the time value of that option. We want to sell that option, but we don't want to sell it naked so that we have unlimited risk. So we'd like to attach a little insurance policy, and that's where the hedge is coming from. But, as we all know, the market rarely ever seems to cooperate with exactly what we think is going to happen. So what can you do if the trade moves against you? Here's where the morph can come in. So this is the profit and loss diagram for a typical butterfly. And for this example, I'm going to assume that we are long the $100 call. We're short 2 of the 110 calls, and we are long 1 of the 120 calls. As I've talked about in previous videos, you could make this with calls, you could do it with puts, you could do it with combinations. And what I'm about to show you works for all variations. But for this one, let's just assume that we're doing a standard call spread. So again, this is the profit and loss diagram, and you can see over here that the maximum loss is 4. This is what we paid for the spread, so that would be our maximum loss. And that's why these wings out here at the far left and the far right show a maximum loss of 4. That's the worst that can happen. The maximum gain is 6. And the reason for that is that in this example, it's a 10-point spread. That's just the difference in those strikes. So if we spent $4, then the best we can do is to make up that difference, or 6. But let's say that we've got this spread on, and obviously we want the stock price to sit still right in this area somewhere in here. This is ideal. Again, this is why it's called a neutral strategy. But for some reason, the stock hasn't cooperated and it's moved way up here, let's say to 125. Or maybe it's gone in the opposite direction, way down here to 95. So that if we were at expiration, we would be faced with maximum losses. But because there's still time remaining, what could we do? Is there something we can do that would give us a better chance for success? And the answer is yes, and that's where the potential morph comes in. Now again, there's a lot of different types of morphs, and they all depend on a set of assumptions. You don't just morph something because you can. So the one that I want to show you here makes a very specific assumption that you must expect a quick move in the opposite direction. A couple of key words there. Quick, meaning fast and aggressive, and in the opposite direction. It's important that you don't hope. I know that sounds funny, but a lot of traders do this. They get themselves in a temporarily losing position, and they do a particular morph. And you ask them, why did they do it? Well, because I can, and because I'm going to hope that it does this or that. Don't do that. You need to have a good reason. So in this instance, maybe you're looking at an engulfing candlestick pattern or a kicker pattern, maybe off of a major moving average, but you've got some good reason for saying, we're expecting this stock to snap back quickly. So the morph for the butterfly spread under these assumptions is to simply close the profitable leg. So if the stock has moved up, in this example, you could close the debit spread. If it's moved down, you could close the credit spread. And regardless of which choice you do, it's going to increase your maximum loss, and it's going to decrease your maximum gain. Now you're probably thinking, wait a minute, that looks backwards. You're saying I can increase my maximum loss and decrease the amount that I can make. Why in the world would I use it? Well, there's a very good reason, and that is because it's going to increase our chances for success. And here's why. Here's our original butterfly spread, and again, we're assuming that the stock moves way up here to 125. So to make these two vertical spreads a little easier to see, we're going to separate the top two right here and actually show them as two separate 110 calls. So again, remember that butterfly spreads can be viewed as two vertical spreads. Over here on the left, I'm long the 100 call and short the 110. That is a debit spread. It's a bull spread. On the right, I'm short the 110 and long the 120. That's the credit spread. It's a bear spread. So if the stock is way up here at 125, which of these two spreads is more profitable? Obviously, it's the bull spread. It's the debit spread. It is the long 100-110 pair. So the rule said to simply close that spread. So keep in mind that if we were at expiration right now with the stock at 125, that spread by itself would be worth $10. But we're not at expiration, so it's going to be worth a little less. Let's just say maybe it's trading for $9.50. Here's the trade that we would do. We would simply sell the 100-110 call spread. And again, for example, let's say that we get a credit of $9.50. Well, what does that do for our max gains and losses? It's very easy to figure out. Just track your cash flows. Remember that the original debit was $4. Now we just took in a credit of $9.50. What's the net between those? $5.50. And specifically, a credit of $5.50. What are we holding? We're holding the credit spread. So effectively, we now have a credit spread for $5.50. And whenever you have a credit spread, the most you can make is the amount that you received. So in this case, our new maximum gain is $5.50. Well, if you remember, it used to be $6. So the max gain is reduced from $6 to $5.50. If we have a 10-point spread for a credit of $5.50, the most we could lose is that balance, or $4.50. It used to be $4. So now my max loss has increased to $4.50. So very easy to figure out your new max gains and losses. So here was the spread. We've now closed these two out, and that leaves us with the short 110-120 vertical spread for a credit of $5.50. So we have morphed from this look into this. So once again, why did we do it? What's the benefit if we've reduced our gains and increased our potential losses? Well, go back to the original profit and loss diagram. With the stock way up here at 125 and our assumption or our expectation that it's going to snap back in the opposite direction, what's most likely? That it stops and hits the brakes at exactly 110, the point of our maximum gain? Or that it continues to fall and shoots right through there? Well, if our outlook is that we are expecting a fast, aggressive move in the opposite direction, it's kind of unrealistic to think it's going to suddenly stop right at 110. Highly unlikely. We're putting the odds more in our favor because when I morph from this look into this, see, I don't just need the stock to stop at exactly 110, like I did for the butterfly. I can afford to have it fall anywhere below. And even if it stops at exactly 110, I'm still at maximum gain. But I'm just giving myself this added cushion if it should shoot well below that. So yeah, I'm willing to take a little less money, but greatly increase my chances. So think of how this fits in with the risk-reward relationship. When things are less risky, people spend more for them. So synthetically, we've gone from spending $4 to $4.50. And when things are less risky, you reduce your rewards too. I've reduced from $6 to $5.50. So this is another way of understanding why this position now has a higher chance for success. Now, if we had done the example where the stock fell below our strikes down here, let's say to 95, it's exactly the same thing, but now you would just close the credit spread, which theoretically you'd like to close for $0. Maybe now you're going to spend 30 cents for it, and that increases your net debit, and then just work through the mechanics from there. The main thing to understand is that morphing gives you more choices. And when you have more choices, you have more opportunities for profits. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.